You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network for you, the busy financial advisor or asset manager who's looking to learn a little bit more about this part of the financial markets, how these products work, how they tick, and how you can use them in your own portfolio. It's also for you guys out there who are maybe looking for a new advisor, want to see what skill sets they should be bringing to the table from an options perspective. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the aforementioned Options Insider Radio Network. And, of course, you can always find archived episodes, new episodes as well over there. The easiest place to find all the archived episodes for the Advisor's Option, the mothership, theoptionsinsider.com. You can also head over to your favorite provider of choice. Could be your iTunes, your Stitchers, your Google Podcasts, whatever podcast provider you prefer or app, and grab it there as well to search for the Advisor's Option, or indeed just grab our full network, the Options Insider Radio Network. It's there along with the other 14 programs on our network. Of course, you can always grab our own mobile app available for iOS, Android, and the beloved Fire OS. And however you listen, if you listen on our app, you listen on someone else's app, you listen via the website, however you get it, make sure you hit us up. Questions, comments, insights, pearls of wisdom. We do love to hear from you guys. And joining me on the program today, let's kick things off all the way out in the Sunshine area. I can't say the Sunshine State, maybe Sunshine State adjacent of Puerto Rico, of course, where we are joined by the dynamic duo from Swan Global Investments, starting off with Chris Hausman. He is the portfolio and chief technical strategist over there. Chris, welcome back to the Advisor's Option, sir.
Hey, Mark, how you doing today? Thanks for having me again.
I am doing very well. It's a lovely day here in Chicago. Not that I would see it because I'm deep in the bowels of the studios here producing shows, but someday I'll get out there, and I'm sure it's very lovely when indeed I do. Perhaps not quite as lovely as Puerto Rico, but we all have our crosses to bear. And also joining us from the Swan HQ out there in Puerto Rico is Ash Vias. He is the Director of Portfolio Strategy and overlays over there at Swan Global Investments. Ash, welcome back to the program to you as well.
Thank you, Mark, for having me.
Glad to have you on, sir. And rounding out our co-host, our cohorts of co-hosts, is actually, he's been on the program before, but he's a newcomer. We just bumped him up to a big co-host chair, listeners. He is Matt Amberson, the principal over there at Option Research and Technology Services. Matt, welcome back to the Advisors Option, and we're glad to have you on as a regular part of the program going forward.
I feel the pressure, and it's great to be here.
It's your first big show, so hopefully you knock it out of the park. That said, you were on a few episodes back, but we might have some newcomers coming in, and since you're going to be part of the program going forward, let's set things off right. Why don't you go ahead and give our listeners, once again, a little overview of what the heck ORATS is and what you guys do.
Yeah, thanks, Mark. As our great intro voiceover said, we started on the SIBO quite a few years ago, where I was able to back traders, and we developed ways to look at volatility and forecast volatility. That eventually morphed into a large backtesting platform, mainly so we could prove out how well our data works. And now it's become quite the product for us. Large pension funds, individual traders, hedge funds are using it to test out various strategies. We've made a lot of advancements in it where you can delta hedge, you can put in your own signal dates. And so that's a lot of what we're doing these days. And, it's perfect for us to be here on the Advisors Options, because that's the biggest growth that we're seeing, are advisors coming to us for some help understanding strategies, how they work in various situations. And the back test is a really good way to see that.
Well, let's do just that. Let's help these advisors understand these options. It's time for our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101. This is the portion of the show where we break down some of those basic options concepts for you here. And, they don't get more basic, more fundamental to the options market, indeed to the options product, than the Greeks. They are the big five Greeks, primarily Delta, Gamma, Theta, Vega, and as we talked last time, sometimes once in a while, Rho. I think we have a couple questions about that a little bit later. We went a deep dive into Rho last time. People like that, so we thought we'd continue the deep dive into the Greeks. It's always good, even if you think you're familiar with them, to have a bit of a refresher. And, we're starting you guys out in the deep end of the pool. First, we started you off with Rho, which is a bit of somewhat a head-scratching one, and also one that doesn't always rear its ugly head too often, so you have to kind of understand when it is actually applicable. And now we're getting into what I would consider to be the Greek of those big five, really the big four, but of the big five that really most people scratch their heads on the most when they first come to, and that is Gamma. And Gamma is an interesting one for a lot of reasons. I know you guys over there at Swan had a big write-up on your site. If you haven't been over there, swanglobalinvestments.com in a while, they have a blog section. Click on that blog tab, and you'll get all their Greek lessons explained. And this one was Gamma explained, and so it's a good time, I thought, to dive into all things Gamma. First off, Chris, since you wrote this article, you've been dealing with Gamma for quite some time. Why don't you give us an overview of the article and some interesting things, and we'll get into a few of the salient points from your article.
Sure, no problem. So I think a lot of people are familiar with the quote, "The only thing that is constant is change," and that's extremely appropriate for option theoretical values or option premiums. I got to delve a little bit into the option pricing model, but the good thing is you don't have to be a rocket scientist to understand why it works, but you do need to understand some of the inputs that go into an option pricing model, because unlike stock, options are multidimensional, right? So they kind of, when I'm explaining options to someone, is like, okay, stock can go up and down. Everyone understands that concept, but options, they kind of go up, down, sideways. They're four-dimensional, if you will. So what are some of the things that we need to be cognizant that go into an option pricing model to get these theoretical values or what, where things are trading at in the marketplace? So some of the things that go into the model is, underlying price, the stock price, right? We need to know a strike price. We need to know volatility, days to maturity, interest rates, and dividends. So it's pretty straightforward. I think anybody who's trading options out there who's done a little bit of homework knows that these are the basic inputs that go into an option pricing model. But what's more important is when these inputs change, how is that going to change option premiums? Because that's what we're doing, right? We're trying to buy low and sell high, right? At the end of the day, I can't put that phrase any more basic: buy low, sell high. So having a better understanding of how the option premiums are going to ebb and flow is going to make you a better trader, going to make you a better portfolio manager if you have options embedded in your portfolio. So part of the model is kicking out these Greeks that we've talked about here previously, right? And the big 5 Greeks, as you mentioned: delta, gamma, theta, vega, and rho. So the interesting thing about gamma, which we're going to be talking about today, is it's not a first derivative, meaning it's not going to directly tell us if one of these inputs into an option pricing model changes, how much the option premium is going to change. So for example, delta. We all know that delta tells us exactly how much the option premium is going to change for a $1 move in the underlying. Vega, we know it tells us exactly how much an option premium is going to change for a 1% move in implied volatility. Straightforward. Theta is going to tell us exactly how much option premium changes for a 1 day in time passing. And interest rates are rho, right, for a 1% change in interest rates. So it's pretty straightforward for those 4 Greeks. Gamma does not do that. Gamma is not going to tell us exactly how much option premium is going to change for a change in underlying. Gamma is really the only one of the big 5 that's a second derivative. So it's a derivative of a derivative, and it's a derivative of delta. What it's going to do is tell us how delta changes for a $1 move in the underlying. And that's a pretty important concept because delta is, again, right, the only constant we have in options trading is change. And we have to understand how all these changes are taking in effect when we're managing a portfolio of options. So gamma has some definite properties. We can talk about some of the basic properties. Lower price stocks are going to have more gamma because remember the definition is off of a $1 move. So a $1 move on a $10 stock is a lot more than a $1 move on a $100 stock or a $1,000 stock. Another thing that is very important about gamma is that it's the greatest on your at-the-money options. And I use this extreme example, right? If we have an at-the-money call or an at-the-money put, the option pricing model is going to kick out a 50 delta, right? So let's assume that expiration is 1 second away and the stock price is exactly equal to your strike price. Well, if that stock ticks up right when it turns into right when it hits expiration, well, your call delta is going to move from 50. It was originally an at-the-money delta to 100, and your put delta is going to move down to 0. That's a big move in gamma, right? So that change in delta all the way from 50 to 100 in the case of a call, or from negative 50 to 0 in the case of that at-the-money put, is the change in gamma. And that's very important because when you're managing option portfolios, you may see delta neutrality, we call it, right? So on the surface, it looks like, well, I don't have any exposure to underlying movements, and so I'm safe there. But gamma is kind of like a hidden risk. It's a hidden Greek, and that's why it's like the second derivative. It's kind of like the Greek that hides behind the door in the closet. You can see all the other ones, but this one's off to the side. But it's something that we need to be very aware of. You need to be very aware of it, especially if you're trading shorter term maturities, because like that example I just gave, an extreme example, right at expiration. But that's kind of how gamma works. Okay, I mean, take that same example with an option that has 1 year or 2 years out. Well, those deltas aren't going to move from 50 to 100 or 50 to 0 just because the stock ticked a few pennies, right? It's more pronounced in the shorter term. So, and why do we bring this up as well? What's happened over the last few years is, the CBOE now lists over 30 expirations in the Standard & Poor's 500 SPX. A lot of those expirations are considered weeklies. You've got expirations on Monday, Wednesday, Friday. You have month ends now. You've got quarterlies. It's not inconceivable to have an expiration 4 out of the 5 days. And I'm pretty sure they're going to make it so that we have an expiration every single day at some point in time. So it's one of the terms. We're not going to get into gamma scalping right now, but one of the terms when we look into gamma scalping is called flying deltas. And so this concept of your deltas could, at one point show delta neutrality, but then all of a sudden blow up in your face. And this is one of the big risks when you're trading these short-term option strategies, and especially for strategies that are going to harvest premium, right? We all know that harvesting premium, or I said I wasn't going to say that in the show anymore. I was going to say premium extraction, right? So if you have a premium extraction program, it's very important to understand gamma, how that's going to change your deltas, how that's going to affect your portfolio. And it's definitely one of the Greeks that you need to be cognizant of, because I know plenty of traders or portfolio managers who thought they were delta neutral, underlying moves substantially, and they're getting closer and closer to expiration, and then they have to deal with these flying deltas. So it can be a challenge, and it's definitely something that you have to be very, very cognizant if you're trading shorter term strategies.
I like that, flying deltas. There's a lot to get into. I'm glad you got into gamma. This is one of the ones. I think you probably saved it for last. Am I correct, Chris? Because it typically is viewed as the most confusing of the big five. Is that why you saved it for last in your series of breaking down the Greeks?
Yeah, it's not the straightforward one, but it's definitely important. I mean, it's you hear stories about people, all of a sudden they had option positions that exploded on them. Well, what's the reason for the explosion? The explosion is because gamma's there. It's this hidden Greek, and it is taking effect on their deltas. So it's about, delta management, especially with market neutral strategies, is extremely important. And gamma is one of those tools to help you manage that delta neutrality.
Now, we see this a lot. So, you could apply this progression to just about any newcomer to the options market. It could be a basic retail guy, it could be a financial advisor, it could be someone else entirely. But the progression usually is this. They come to the options market, usually from the stock world. So they have an understanding of underlyings. The stock goes up, the stock goes down. You could buy it, you could short it. They understand that concept. And so they take that now and they apply that to options. So they usually look at options in the beginning as some sort of surrogate for the underlying. So they're pretty much focused on delta, whether they understand that or not. They're focused on delta. They want to buy a call and they want the stock to go up. They want to buy a put and the stock that goes down. Eventually, they start to get a little bit more sophisticated, and they start to maybe understand the value of selling options, aka harvesting the risk premium. As you said there, Chris, we've heard that. How many times have we heard that this year? I'm sure it's not the last time we'll hear it, even though vol kind of eroding still, so not quite as attractive to harvest that risk premium as perhaps it once was. But that's a conversation for a little bit later. That said, they start to learn maybe about selling options. They start to learn the income component, which is theta. And so they start to understand that concept of time decay. Maybe eventually they get a little savvy. They actually start to understand the vega component as well and how those Greeks intermingle. And yet very few of them really ever develop a strong grasp of gamma. But as you pointed out, it is indeed a very subtle risk. It's there, it's lurking, it increases exponentially as you approach expiration. One of the problems we used to have, I'm sure Matt and Chris and you guys had it as well on the floor of the CBOE back in the day, was you had to kind of just throw away the machines and the sheets in the final days of expiration week because the gamma was just increasing exponentially. Nothing could really calculate that. And so we got a better handle on it now, but still it's just this issue of just this incredibly changing thing. On top of that is a second order derivative, so it's not quite as intuitive as something like delta, where there's a straightforward relationship between that and the options price. There's a relationship between gamma and then the delta and then the options price. So there's a couple extra hurdles in there. And the counterpoint to all that, of course, is a lot of people are out there, advisors and others, using options for income. They're selling covered calls, maybe doing collars or put spread, short put spread, things like that. And they don't realize they're racking up these giant theta positions. They don't realize theta and gamma go hand in hand. They're two sides of the same coin. If you have a lot of theta, you're going to have a lot of gamma and vice versa. So if you want to sell options, you have to understand gamma because you're putting it on whether you know it or not. So it's a very important Greek, and unfortunately, I think because people are so intimidated by it, they don't often sink their teeth into it as frequently as they should. Matt, you guys over there at ORATS are doing a lot of different back testing. Obviously, you're breaking down the options market in a lot of different ways, looking at strategies, how they perform for delta and vega and around earnings and things like that. Of course, you spent your days over there in the SIBO as well, I think on the PICOS as well as a market maker, so you've seen gamma in all of its various incarnations. What are your thoughts in general on gamma, and maybe some takeaways you have for the advisors out there who are just starting to tread in the gamma waters? And also, if you have any thoughts from all the legions of back testing you've done, do you have any sort of gamma-oriented back test? Or if not, maybe that's something interesting to consider down the road over there at ORATS.
Yeah, I think it's great that we're talking about gamma. I think it's the most important Greek. It's really, from a risk management standpoint, where, what is your gamma and where does it kick in? As you get closer to, let's just say you're even tail hedging, as you get closer to those strikes, that's where the gamma kicks in. That's where if you're tail hedging, that's where your profit will kick in. One of the things that we did for years is I noticed on the floor that stocks would move intraday quite a bit, and we always had to adjust our positions, or we did adjust our positions, and the intraday movement didn't really jibe with the close-to-close volatility. Now, this is a management technique that we used with gamma to determine volatility. So basically what we did is we gave ourselves a certain amount of gamma in a simulated position and traded that, buying and selling stock like you would to keep your deltas neutral. The gamma is making you buy and sell stock because it's changing your delta. And so we did, Mark. We back tested the best areas to hedge your change in delta, which is your gamma, and we would come up with rules on various stocks. Like IBM, you'd like to let it run more, whereas like back in the day, Nextel would move a lot intraday, and we would use gamma to set up hedging strategies, and we would set up option positions. It was interesting how you'd have to simulate an option position at different strikes in order to set up a constant gamma position in order to run these tests that we've done. So I know that might be another level, maybe different from an advisor might use, but definitely gamma is, as you get more advanced in options, I think the most important Greek out there, because that is really, like you said, where the theta comes in, where the profit comes in on a tail hedge strategy. And as far and like you said before, there's a very close relationship between theta and gamma. Now, if you're short, you want more theta to less gamma, and so we do have scans that help find those types of options, and have scans that will optimize the amount of theta that you're getting in, and trying to be, minimize the short gamma component. And the opposite would be true if you want to be long and want to get as much gamma as you can without the additional costs. So that's what we're doing at ORATS with gamma, Mark.
I think it's fair to say, just judging from your description and what you told me in the past, that your various struggles to overcome gamma and you work it to your advantage are probably maybe to blame for all the things you're doing these days. Is it fair to say that gamma perhaps led to all the stuff you guys are doing at ORATS these days with backtesting and everything else? It kind of was born out of your attempts to develop some systems to trade gamma.
Yeah, I think that's a fair statement. When you're in option trading, you immediately start reading books and you see a lot of formulas and you say, oh, this is how it must, this is how I must trade the stock around my delta and gamma positions. But I think Black and Scholes, I think it was Merton that went down to the floor and actually blew out, trusting his formulas too much. And as you said earlier, you do have to throw out your sheet sometimes. And as Chris mentioned, it becomes a binary event around expiration, and how you manage that. That's the intuition that comes from living through a various amount of expirations and seeing what actually happens. So I think gamma is something that you need to think about, especially as you get more advanced. Sometimes you do need to throw out the fundamentals book on gamma and think about what's really happening. How options, especially right around the strike and especially near expiration and how they change and how that's going to affect your positions, Mark.
Yeah, you start getting to those extreme moments, gamma becomes as much of a dark art as it is a science at that point. So there's a lot of fun stuff to tackle. It's glad to see you guys over there at ORATS have built a lot of systems to do just that. Ash, same question for you. You know, what are your thoughts? Obviously, you're over there directing the strategies and the overlays over there all day long, so you're encountering gamma on a regular basis. What are your thoughts of this Greek, its challenges it may pose, and its import for the advisors out there?
Well, I think I'd agree with both Matt and Chris. I think Matt said he always thought it was the most important Greek, and Chris mentioned the trend towards weeklies. I think one of the characteristics of options is that if you're focused on weeklies, if you're focused even on front month, but the closer you get to expiration, it all becomes a function of gamma and delta. I mean, Vega, your volatility exposure isn't as big of a deal if you're in that close. So, what I would say is it's always been very important, particularly if you are someone trading weekly options or front month options, particularly if you're doing this from the short side where the asymmetry, it can provide income, can also work against you if the market goes the wrong way. You have to be very, very diligent about knowing your gamma profile, as Matt said.
Well, Chris, since you are the author of this article, I'll give you the final word, the final thoughts on gamma before we move on to the buzz. What do you want to leave in our minds of our listeners when it comes to gamma, Chris?
Yeah, just to sum it up, I mean, if you have long options, you're going to have long gamma, and that manufactures what we call good deltas, right? As the underlying goes up, you're getting longer delta. That's a good thing. As the underlying goes down, you're getting shorter delta or less long. That's also a good thing. So in today's environment where there are a lot of strategies that are premium extracting, like I mentioned earlier, well, we're the opposite, okay? So we're shorting this gamma. We're short options. We're trying to collect theta. And so unfortunately, that's going to manufacture bad deltas. So as the underlying goes up, you're getting shorter. As the underlying goes down, you're getting longer, not necessarily what you want to have on, right? So what's very important is to manage, as kind of Matt alluded to, there is a gamma decay ratio out there. There's a formula out there that will tell you this is a good gamma position vis-a-vis where theta is, or this is a bad gamma position vis-a-vis where theta is. So one of the important things to remember when you're managing a portfolio of options, and one of the things that we do here at Swan is we're very aware of what that ratio is, and that's where risk management and all our expertise over the last 20 years or so comes into play, managing short gamma positions, especially during events. So I think it's something that we've been tested over and over again throughout the years that, it's not something, I guess I know ostriches don't put their heads that's a misconception, right? That ostriches put their heads into the ground when there's danger. Well, gamma, you can't be like that with gamma. I mean, gamma is something that you have to tackle on, especially if you're short gamma. It's something that you have to tackle. It's something that you have to be very cognizant about. It can become a very big risk. And conversely, if you're long gamma, if you're trading strategies that are long options that produce good deltas, well, you have to do stuff like Matt said. You have to be able to get in there and scalp that gamma because you have to pay for that theta, right? I mean, gamma scalping, which is what Matt was kind of describing, is really it's rent. I mean, you've got to pay for that rent. That's how you get that extra. I don't want to call it premium, but the capital to pay for the luxury of holding long options, which, as we all know, have a limited risk, unlimited reward profile.
I think maybe it might be interesting to have a future episode about gamma scalping and how some of our listeners can utilize that. It's not for everybody. It's a pretty involved technique and requires some sophisticated margin and account savvy. But I think we have a lot to talk about here. I don't want to overwhelm our listeners right now with too much gamma, so we'll table the gamma talk for now. If you're curious, you want to learn more, I mentioned, head on over to the Swan blog, read the full article, some great charts and visuals there. Of course, check out some of our other programs on the site. Just search for gamma. It'll all come up, and we have some many in-depth discussions on gamma. Meanwhile, it's time for us to keep on rolling right on into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to the buzz. Like the man said, this is the portion of the show where we break down the big news, the big developments for you, the busy financial advisor, asset manager out there who's busy doing what you're supposed to be doing. handling your clients, seeing to their needs, not paying attention to the latest developments. Let us do that for you. And so we're going to kick things off. We talked a lot on the last show. It's still kind of the topic du jour these days, which is just the ever vanishing volatility. We talked on the last show. We had Ilya and I think Mike Tucson and some others joining us on the show to talk about some strategies for selling options in a low volatility environment. Well, volatility, if anything, has continued to creep lower. Ye old VIX cash back into the single digit range. As we're recording this right now, it's 9.65. It hit about a 23-year low earlier this week of about 950. So volatility is getting out there. From an implied perspective, we're seeing things like the VIX futures really get crushed as well, setting new contract lows for things like the August VIX futures contracted things. So volatility is getting out there. That said, realized vol, it has been very low in the past 50 years. Only been a couple other periods, the mid 60s and actually 1994. When realized vol was at or below these levels. That said, in the last few sessions, it has ticked up a little bit. Realized vol in the S&P was hovering around between 5 and 6%, which is pretty anemic. Now it's up to about a 7.15 30-day historical vol out there. So a little bit more juice. That said, it's interesting to see. Now you have an interesting scenario now where implied vol continues to come in and historical vol, realized vol is ticking up a little bit, so it makes it even more dangerous, a little less attractive to harvest the quote-unquote risk premium out there, because we all know the risk premium is the implied minus the realized. Implied usually is higher. But in some of these weird scenarios, it does make it challenging. That said, maybe Chris, we'll start with you. You guys are out there trying to harvest that risk premium every day for the short legs of the DRS. And I know you had another month to think about some of the things we talked about in that episode last month about selling options in a low VIX environment. And of course, since then, the VIX has gotten even lower. So what are your thoughts on this continued erosion of volatility out there and how it's impacting the options market, and in particular, how it's impacting you guys?
Well, I know it's surprising to many, but what I'm about to say is actually it's been a good income producing year thus far, even though we are at very low absolute levels of the VIX. This is kind of the situation of the glass half empty versus the glass half full, right? When you talk about volatility, especially in any type of premium harvesting program, it's a relationship, and all of us were market makers on the floor. And what was the most important thing? How did we make money down there? It wasn't about trading absolute levels. It was about trading relationships, relative values, right? And that's the same thing with trading volatility and harvesting premium. It's not about just the VIX by itself. I mean, anyone can go back in history and see, it's a 19.5 average since 1990, but how many people follow that up with saying, but you know what the mode is, or where does it trade most of the time? In the 12 handle. It really does trade on the lower end, but people are so fixated with what the average is, and averages can be misleading. So most of the time, it does trade around 12. Now, yes, what's going on right now is unprecedented. I've said on this show several times, well, we've been through this before 2005, 2006, early 2007, where the VIX was very low as well. And I'm a big believer, because we have stats and data, that market cycle and volatility cycles as well. What's happening now is, well, we're starting to go even further back in time and we're breaking records that were back in the early 90s. So one record that could be broken today, so this is almost hot off the press as we speak. We just had 4 days where the VIX closed below 10. The last time that happened was in December of 1993. So if we close below 10 today, that's going to be 5 days in a row, and that's going to be a new record. So yeah, we are definitely in new territory with respect to volatility. And so there has been a changing landscape over the last few years, and maybe we'll get to this later on the show, a shift of how trading styles are today, from very aggressive trading to more passive. I mean, there's a lot of different factors. All these new volatility products that have come out, risk parity products that have come out, have all kind of dampened the volatility environment in conjunction with a new administration, a lot of new hope and promises of tax cuts that should stimulate the economy. So things look good. Things look steady out there right now. And a lot of the rally is momentum based right now. It's based on what's going to happen in the future. Implied is a guess on what's going to happen in the future. And I don't know what the future is going to hold tomorrow, and neither does anyone else. And also, if you're going to take on this gamma risk that we just finished talking about. Well, you need to be rewarded. You need to be rewarded via theta, and that theta is driven on different volatility levels. So in a nutshell, even though we are at low absolute VIX levels, that relationship, that risk premium, the difference between implied and realized, is still pretty healthy. And about 6 months ago, when I study the risk premium quite a bit. I mean, I made a call that, hey, we had bottomed out. And over the last 2 quarters, it started to pick back up. Now, the last few weeks, it's kind of diminished a little bit. So again, it cycles. It's something that you need to be aware of all the time. But I'm in the business of managing relationships and managing relative values, not absolutes. So I think that's the difference. And having that experience of being on the floor for so many years, like all of us do, right now on this call, that's what separates from people who are just getting into this game, if you will. If they're brand new to premium selling, they're fixated too much on absolute levels and averages, and that's, yes, it's part of the equation, but it's not the way to make money at the end of the day. Okay, and I can't forget that even though we are at low vol levels, risk management is part of the equation as well. So we have to be able to manage relative prices. That's how we extract premium, but we also have to be aware of, well, what could the risks be in case volatility does start to pick back up, right? In case gamma does start to change on us, in case interest rates start to change on us, in case underlying starts to change on us. So you can kind of see, as a manager of a book of options, there's a lot of different things that we have to be constantly aware of.
Yeah, that's a good point. I think it'd be probably surprising a lot of people out there to hear that it still has been a decent year for income trading, even though these levels are fairly low, because as you mentioned before, there still is that risk premium and maybe getting a little bit more challenging to harvest these days, but still it is out there. And as we have seen, a lot of large publications like the Journal and Bloomberg and others have woken up to this notion that this short vol trade is out there. I think Wall Street Journal is referred to as a volatility feedback loop. People are saying everyone and their grandmother now is suddenly short volatility, short VIX out there. So everyone has collectively awakened over the past 6 months to a year on this trade. I think a lot of people came to it after, let's say, the Brexit vote, and certainly after the election, when volatility spiked and then came in again very dramatically. So even if you were short vol, you still did fairly well. And we've seen that a lot in recent months as well, when there have been spikes, but they've come back again almost as quickly as they shot back up. So the pain period, which used to be pretty epic for being short volatility, short VIX, has started to be a little bit more manageable if you're deft about it. Speaking of managing things, Matt, it's what you guys do over there in terms of helping people develop some strategies and some plans for how they should be managing this. I have to imagine you guys are getting a lot of inquiries about this topic right now, about what should they be doing in this low volatility environment. Maybe they're coming to you saying, hey, I'm a hardcore in the money or out of the money covered call seller or something else like that, some other option seller. How does my strategy look in this environment and these types of volatility environments? So are you seeing a lot of this type of stuff over there at ORATS these days?
Yeah. One of the rules of thumb that was a bit shocking to me when I started doing a lot of back tests maybe 10 years ago, we started to see that the market doesn't get volatility high enough in situations where the realized or statistical volatility is high, where things are really moving around. And conversely, the market doesn't get the implied volatility low enough in low volatility situations like we're in. And what that means for someone that's managing options is that you can make money, as Chris mentioned, selling options in a low volatility environment. At ORATS, we do this thing called TOES, Tested Option Environment Strategies, where we will change the type of strategies and the distance of the strikes, for example, from the at the money in lower vol times versus higher vol times. And we have this all tested out, and our advanced clients are doing well in these types of situations. But at these low volatility environments, sometimes we see in our back testing that these are the most profitable times. And I mentioned that a few months ago, the same statement. So that's one thing that we think about. And the other thing that I think is interesting is that if you look at the term structure, and when I say term structure, you'll see an at-the-money volatility in, let's just take SPY, for example. and you'll see the short-term implied volatilities, and you'll see that they're hovering, maybe somewhere around 6 or 7, and then but the long-term volatility, out a few years out is at 14 or higher, and so that term structure relationship is an important one, and we could talk for a long time about that and how it's changed, but we're actually starting to see that come down. The FAR month volatilities, talking 2019, those don't usually move that much, but a funny thing is we're starting to see them come down. So I think that's they're finally giving up the ghost, so to speak, on those farther term ones. And then the last thing that I would mention is that correlations, diversification is extremely important, especially in these ETFs. And if everything's moving together, there's a correlation of 1. And so the ETFs will have an implied volatility closer to its constituents. But what we're seeing now is that the constituents are moving in a manner that isn't that correlated, and their implied volatility of the constituents divided by the ETFs, that relationship is getting quite high. And when it's high, it shows the benefits of diversification. And when it's high, that shows a healthy market. We put out a report called the Component Report that we track that ratio. And the higher that ratio is over the years, the better the market has done. And it's been going up and up and up. Some of you actually receive it, and it's hard to fathom, but that's what's actually driving a low volatility as well, this lack of correlation. So those are the points that I take from this, Mark.
And last but not least, Ash, your thoughts on this? You're always looking at volatility, doing a lot of research, looking at correlations, sometimes dubious correlations, which I'm also a fan of, and also the term structure out there. So what's been catching your eye out there over the past month in terms of these kind of historic levels we're seeing out there, and historic lows really across all products, not just the VIX cash, which isn't really a product per se, it's more of just an index, but of course you have the VIX futures and all these other products that are hitting and setting new contract lows, it seems like, on an almost daily basis these days.
Yeah, well, we're definitely seeing stuff like that. We're definitely seeing things, like implied levels below realized levels, which if you were short volatility, it's no surprise that even in a overall low volatility environment, that it's a good income environment. I think, the one thing that I would emphasize is, volatility, regresses to the mean over time. And let's say an option price trade ranges from between $1 and $10 over the course of its history. You can still make very, very good money selling the thing for $2 or $2.50, but you should probably be much more active in managing it because you're not getting as much cushion as if you sold the option for $5. So, well, I completely agree. You can make a lot of money in a low volatility environment. You should lean towards active management. A lot of these passive strategies that we see where people have a quest for yield at the rates where they are, you can make good money with them. But if you're not diligent about managing the gamma, which we mentioned before, this is how people get bit. This is how people get caught.
Let's move on to one of our favorite things on the show, which is, of course, studies, data, hard data that we can discuss and debate. And I think we're going to do that in this case because we have two pretty much simultaneous studies studying very similar areas of the space, the alts, which is, of course, a popular one for us, as well as hedge funds, which I know we play in as well, and coming up with somewhat different conclusions, which is kind of interesting. The first, I guess it proves the old saying of there's lies, damn lies, and statistics, because we have the first study coming out of Willis Towers Watson, I believe. They surveyed 562 asset managers with some 6.5 trillion under management. They were focusing on the biggest 100 biggest alternative asset managers out there. They said their AUM swelled to about 4 trillion last year. That's a 10% increase over 2015. So they're saying things are good out there. In terms of where the biggest allocation, this gets into something we talked about on the show before, are the kind of the loose aggregation that is alts. They kind of throw everything in there. There's private equity, that's 18%. Private equity funds of funds, which apparently is even a different category, that's another 12%. So those two combined are about 30%. Illiquid credit, 9%. Funds of hedge funds, 6%. Actual hedge funds, 17%. Infrastructure, 4%, and the commodities, 1%. That's the breakdown of where all those assets are coming from. And according to the research, pension funds represent about a third of all the assets allocated to those top 100 alternative managers. So it's safe to assume they are increasing their allocations to alts because the alts are up about 10% over the past year. So that's an interesting thing. That's something we talked about a lot. I know we talked about the RMC conference recently as well. How do we get more money into this space to invest? How do we get more pension funds on board? And sounds like those efforts are bearing fruit. But interesting thing, in terms of their findings that were maybe a little bit contradictory, they also found in terms of which asset classes were growing the most within the alts ghetto, as we've lumped it, because they throw everything in there. The biggest asset class by growth over the past year was illiquid credit. That experienced the biggest percentage increase with assets under management going from 178 billion to 360, so just about doubling. And of course, it's one of the smaller end of the spectrum, so it's easy to deliver big ticket percentage changes there. Meanwhile, they say investors cut back on their allocation to direct hedge fund strategies among the top 100 managers, with assets falling by 80 billion to 675 million. Now, the reason I say it's contradictory is at the exact same time, Credit Suisse came out with their survey of institutional investors. And their headline is hedge funds maintain big investors' favor. So a little bit of a contradictory data point here. They found that their mid-year survey of institutional investors found that funds continue to allocate to hedge funds in the second half of 2017 and increased interest in quantitative strategies. In the medium term, they surveyed 212 institutional investors with about 660 billion in hedge fund investments. So a little bit less AUM, but similar type scope, including pension funds, family offices, etc. They asked them, and 81% of those investors in the poll said they were likely or very likely to allocate to hedge funds during the second half, up from 73%, during the second half of 2016. So their inclination to do so is increasing, not so much the assets themselves. So a little bit different maybe data set here. Also talking about something a little bit different. Hedge funds are, of course, part of the alts, but alts themselves are a much broader and wider beast. But still, this kind of brings to light the issue we come across a lot in the space, which is, one study will tell you one thing, and then the next study will tell you almost the complete opposite picture. Interesting takeaways. Ash, maybe we'll start with you because you're always out there, knee deep in various studies and research. What are your thoughts on these two conflicting data points here for hedge funds, which I know you guys are active in over there at Swan, and then B, our continued, I guess, debate should continue again about what they lump in as alts. You see this list of alts. I forgot to mention real estate. Real estate is in there as well. They list all these things. There's no real breakout for what I think a lot of us here would really truly call alts, which is some sort of overlay thing like you guys are doing, or maybe managed futures, things that really don't have the correlation. I think there's a lot of work to be done still just in evolving that alts definition to be a little bit more specific and probably a little bit more appropriate to what we're doing. So a lot to unpack there. Your thoughts, sir?
Well, I'll start with the last thing you said. I definitely agree that, the alts definition has come a long way, but it still has, a lot more robustness in it as far as we're concerned. And even like, we talked about Morningstar and differentiating between the different types of funds which use options. It's on there now, but it's still got a long way to go. To your other question about these two studies, I'm not sure if they're necessarily contradictory. I mean, I think you see two trends, and they both seem very evident, particularly when you're in a low interest rate environment. And that is, from the investor perspective, it's very easy to get swept up with absolute returns instead of risk-adjusted returns. I mean, if I tell you a strategy returned 5%, and another strategy returned 15%, most people think the 15% is better, and it is in absolute terms. However, you have to look at the amount of risk they took to generate that 15% versus that 5%. I think that's very hard for people to get their head around. The second thing is from the allocator's point of view, Given the first thing, it's no surprise that if they're going to allocate to some of the largest, most well-known names, not so much because it's the best potential investment opportunity for the investor, but if something goes wrong, you're never really going to get fired for recommending PIMCO. If PIMCO loses money, well, they're PIMCO, right? So I think these are things that investors and advisors have to take into account when they're, seeing articles like this.
Yeah, I think you're right. The takeaways that they blast in their blurbs about the study, the headlines, seem directly contradictory. When you dig into the data a little bit, you realize they aren't directly contradictory because they're talking about a couple of different data sets. One is actual AUM increasing versus one is the intention to, at some point in the next 6 months, allocate more. So this is a little bit different there. So I see where you're coming from there. Chris, your thoughts here as well. Obviously, this is a hotly contested issue we talked about before on the show and probably will again. The issue of what the heck goes into alts, what does alts really mean, as well as some of the findings from these studies.
Yeah, so I'll begin with saying that studies can be manipulated in a way. I'm not saying that these were, but right, we've all heard that saying, right? The data is meant to be manipulated, but I can attest to saying that we have personally seen investors shift away from hedge funds and move more towards hedged equity with yield enhancement, such as what we do with the defined risk strategy. So, again, it depends on who you're talking to, but that's kind of what we've experienced here at Swan.
Last thoughts for you there, Matt. Obviously, this is a contentious issue, but you haven't had a chance to really weigh in on it. So this is your first time weighing into the fray about alts. What are your thoughts on the entire alt space, how contentious it is, as well as these particular studies?
Well, I could talk to what we're seeing, and we are talking and doing work for some of the largest pensions out there. I think if you added them up, our pensions are about $500 billion. And they are, as Chris said, moving away from hedge funds and more into managing it themselves, finding managers to help. But yeah, doing it themselves, looking at tail hedge strategies, back testing, studying, and also income producing as well. So that's just our small view of what's happening out there.
And I'd be remiss if I didn't wrap up the buzz without talking a little bit about the thing that is on the mind just about every advisor out there, whether you're options oriented or not. That is, of course, the ongoing battle that is the Department of Labor fiduciary standard and just continued assault that has come under renewed assault just in the past few weeks. So if you're not a fan of that, maybe that's good news. If you are, perhaps not so much. Except we are recording this on Wednesday, July 19th. And as of this week, 2 House panels are poised to launch their own specific assaults on the Labor Department's fiduciary rule Wednesday. So that would be today. The House Education and Workforce Committee is going to vote on legislation that would repeal the DOL and replace it with an advice standard, which would effectively mean that advisors would have to use more plain language to explain how their compensation changes depending on the type of investing products that the clients purchase. It may seem obvious, but that's the type of language they want to put in there. Also today, the House Appropriations Committee taking up a funding bill for the Department of Labor, which, you control the purse strings, you control a lot. That contains a rider that would effectively prevent the agency from enforcing their rule. So 2 different assaults on 2 different fronts over there. And that is enough. About a week ago, we also saw a hearing for the House Financial Services Committee focused on yet another bill that is also attempting to kill the DOL rule and replace it with what they term a best interest standard that would be proposed by the SEC. So a lot of 3 different attempts right now in the House, at least, to kill this thing. The Republican majority seems to be giving them a good chance of succeeding. They have some opposition in the Senate. This thing tends to break down around party lines. Obviously, the Dems have a little bit more muscle in the Senate. So we'll see how this shakes out. Just want to give you guys a quick update. I think we'll bring on some experts in future episodes to give us a full overview of everything that's going on out there. But it is fast and furious. It changes by the day and indeed by the minute exactly what's going on. But I wanted to at least touch on it. Speaking of touching on things, it wouldn't be a show if we didn't give you guys a chance to beam in and give us your thoughts on a few topics. So without further ado, let's dive right on into our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. Let's kick things off. Actually, we put out a little flash poll here before the show out there on Twitter. If you follow us at Options, and give you guys a chance to chime in. We asked you guys, hey, with VIX hitting new lows and the SPX new highs, what is your financial advisor telling you about using options? Are they out there? They gave you 4 choices. Are they advocating that you write more covered calls, which, as we've just seen, may sound counterintuitive, but it can still work if done effectively? Are they telling you to buy protective puts? Are they telling you to do both, aka put on some collars? Or are they telling you they're not going to touch options with a 10-foot pole? Maybe, Matt, we'll start with you. Give us your vote on what you think, what you think advisors are telling people, and then B, what you think is actually winning our poll. What do you think our listeners are saying?
I think advisors, with all the regulations that are coming down the pike, and we saw in the Shirillis study before that they most need time to understand options. So I'm saying they're probably not touching options. I think you do both. You find good calls to sell, based on testing, and you find nice puts out of the money to buy in case something happens. Mark?
Interesting. I like it. Ash, same question for you. What would your vote be there? And then what do you think our audience is voting for? What do you think is winning our poll?
Well, I think you should be buying protective puts in this environment, but I think they won't touch options is probably winning the poll.
Interesting. So 2 votes for not touching winning, and then different votes for the strategies. Maybe, Chris, you can make it a trifecta. You're going to go for covered calls? What are your thoughts here?
Well, I think you should always be invested, always hedged, first of all. As far as covered calls are concerned, I think, especially now, if you look at the skew, I haven't mentioned that in a while, right, Mark? A lot of the premium extraction that is going on right now is coming from downside puts because of the skew. And if you look at upside calls, that volatility just almost flatlines in a lot of products. So I think you need to be selective. I think there are opportunities in certain stocks. So I'm not going to throw the baby out with the bathwater. And I still think that, keen investment advisors can still be recommending covered calls. They just have to be a lot more selective and do a little bit more homework in today's environment.
So I'm going to put you down for voting for collars because you want to be always invested hedge, and you guys are pretty much in the collar game over there with some modifications.
Sure.
So I'll put you down for collars. All right. So as the live voting is right now, it's been up for a few hours. I think we got about a half a day or so left, about 12 hours. So if you haven't voted, by the time you listen to this, it'll be too late. But you can follow us at Options. We put out a lot of polls over there. And right now, winning the poll with 33% is Ash's vote for buying protective puts. So they're taking your advice, Ash. They're coming in and they're buying some protection these days, even though, like Chris was saying, the skew is getting kind of juicy, so maybe something to watch out for. Still, they're saying, the heck with the skew. I'm buying myself some protection. Second place, 29% so far, saying their advisors telling them not to touch options. So I can kind of see that given how reticent a lot of them are to still do that. And then a 24% saying using collars. So getting a little savvy out there. I like that. Only 14% blasting out the covered calls. So we'll see how those results evolve over the next 12 hours or so, but shaping up kind of interesting. All right, let's move on. This question here, we got a few more minutes. This one comes from listener LCB. He or she saying, hey, regards to low vol selling you guys are talking about in the last show. Hey, guys, you mentioned on the last show this is a challenging time to sell options due to low volatility. So does it stand that the opposite is true? Is it a good time to buy options, particularly protective puts? Well, Ash, you were just advocating in our poll to go out there and buy some puts. So what do you have to say for our friend here, Mr. or Mrs. LCB?
Well, yeah, I mean, from a percentile basis, it's a great time to buy puts, but it's also been a great time to buy puts for the better part of the past, 8 years. These things are hard to time, but yes, something is cheap, but that doesn't necessarily mean the trade's going to work. But if you are looking big picture, we're at, market highs with implieds as low. Yes, it's a good time to buy puts.
Matt, what's the backtester saying? I know there aren't a lot of scenarios that are equivalent to this. We're kind of in not uncharted waters, but testing some new lows in terms of volatility while highs in the index. What is your backtester telling you, or maybe just your intuitive sense from having backtested a lot of put strategies about going out there and buying puts in the S&P or your product of choice now?
Yeah, like you guys have mentioned, it is difficult. I mean, and as Chris mentioned earlier, it's relative. Even though the puts might be inexpensive, the market is not moving, and you might not make money doing that. So again, it's very surgical, finding the ability to do both. To sell good strangles perhaps, and then buy out of the money tails is the way that that I like to invest. Like as Chris says, be long and be hedged. Mark.
Speaking of Chris, we got a good one for you here to wrap up here, Chris. This goes right back to the article you talked about on last show. This comes from Tim D. He wants to know, how high do rates need to be before I need to worry about row? Row is RHO there, Tim. Not, I can see why you want to spell it like a row of cheers, but RHO, just a little nugget for you. That said, Chris, you wrote the article about row, the, shall we say, the less loved stepchild of the big quote unquote five Greeks. But our friend Tim D wants to know, how high should rates be before he starts getting a little worried?
That's actually a pretty good question. I think I'd be more worried about the rate of change and not necessarily the absolute level. Again, it's been a long time for a lot of people trading in a 4, 5, 6, 7% interest rate environment. So, the key thing about row is, right, we said short-term options, really not much of an effect. I don't think it's something that you need to worry about. I would definitely be worrying a lot more about gamma over row if you're trading the short term of the expiration cycle. If you're trading the longer term stuff, it's going to be the opposite. You're not going to have so much gamma, but now row is an important factor. So again, right now with quarter rate hikes, very methodical. The market slowly prices it in, so it's not too much of a concern. But I think if we go back to the days where there's 50-point rate hikes or cuts or 75 bips, 75 bip type changes in interest rates, that's when we need to start really worrying about row, because that's going to affect option prices literally, overnight. Right now, it's very, I guess surgical is the word. It's very methodical. It's very slow. So it's not affecting option prices as much as it did back in the day. So, what that number is for the Fed to start saying, well, forget quarter point maneuvers. We have to go to 50 or even surprise 75s. Who knows what that number is? But I'm just throwing out a number. But I think probably north of 3%, 4% is really when I think the Fed steps in and starts making larger changes to interest rates as opposed to what they're doing today.
All right. Well, that music means, Chris, you get the last word on row. And indeed, the last word in our office hours. We have come up against it. What an epic show. We had so many topics that we touched on the show. And if you believe it, listeners, we didn't even scratch the surface of all the topics we wanted to talk about. We need like a 5-hour show to get it all in. So much going on in the world of advisors and options. But before we go, one last time, let me go around the horn. We'll start with you, Matt, as our newest addition here to the world of advisors option. What are you guys cooking on? What are you guys working on over there in ORATS? And what teases, what hints can you leave our listeners with? And if they're interested in what you guys are doing, where should they go? What should they do?
Yeah, we're very excited here. We are just about to release our web-based backtester. And they could go to orats.com. They could message me at Matt, M-A-T-T, at orats.com. So that's going to be a major new offering for us. We've put a lot of our advanced features in there, and we're really excited about it. Thanks, Mark.
Check it out for yourselves, listeners. Orats.com, ORTS.com to learn more. And Chris and Ash, you guys are always working on interesting stuff. And as we saw today on the show, yet again, putting out some interesting content over there at swanglobalinvestments.com. But if our listeners are interested in learning more, or maybe about some of your events, you guys are always doing some advisor education events, as well as, of course, the DRS. What should they do?
Yeah, you know what? I just want to start off by saying that this month marked our 20th year anniversary of managing the defined risk strategy. And we do put on those 10th box events, which you just mentioned, Mark. We're going to start those up back in September after the kiddos get back to school. Those are a series of regional due diligence meetings. We have portfolio manager roundtables where, challenges and opportunities in today's investment world are discussed. So in essence, it's a great opportunity to meet the PMs in a more intimate setting, if you will, and discuss the defined risk strategy and how it can fit in a portfolio.
Thank you for that. Yeah, interesting stuff you guys actually put out on your website. I was looking at this the other day. An interesting write-up of just all the events that have gone on in the marketplace over that 20-year history of the DRS. Of course, you have long-term capital management. You have the big wipeout in 2000. You have 9/11. You have 2008 financial crisis. A lot of big things have happened over the course of the time you guys have been running that strategy. So interesting stuff. If you want to see some of those data points for yourself, head on over there, Swan Global Investment. Maybe you want to register for one of those events. That might be pretty interesting for you. By the way, again, just for Matt over there, it is ORATS, ORATS.com. I may have said something else there, but ORATS.com. And last but not least, I do want to thank our friends over there at OIC. They once again are busy out there educating you guys, the advisors on the road, so they couldn't join us. Head on over there to optionseducation.org. Check out what they have for you. You have to register for it, but once you do that, you get access to really a ton of great studies, a ton of great data. So if you're wanting some hard data to really sit down with your clients and explain to them why they should be using options, what benefit could really accrue to them over time in their accounts, they've got it for you, optionseducation.org, to learn more. And on behalf of myself, our friends over there at the OIC who couldn't make it today, and Matt and his team over there at ORAS, and of course, Chris, Ash, Randy, and the rest of the team over there at Swan, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing, and of course, for sending in such great questions. Keep them coming. And we'll see you next time for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.